In the last video, we built a volatility regime model. It was simple. We estimated volatility using an EWMA filter. We defined high and low volatility states, and we used that to clarify market regimes. But we never asked whether those regimes actually mean something. When volatility is high, is the market also falling? Or are high volatility periods spread equally across positive and negative returns? If you look at major equity crashes, the pattern feels obvious. Volatility spikes and prices fall. So the intuition forms quickly. High volatility means downside. But that intuition is built on extreme periods. Crashes are vivid. They stay in memory. Most days are not crashes. So the question becomes, outside of those extremes, is there still a consistent directional relationship between returns and volatility? And does it look the same in every asset class? We want to make the question precise. We are not asking whether volatility is high or low. We are asking whether volatility reacts asymmetrically to returns. The specific metric is the following correlation. Here, R of t is the log return on day t, and delta sigma of t plus 1 is the change of volatility the following day. We measure delta sigma rather than sigma directly. Volatility levels are persistent by construction. Today's estimate strongly predicts tomorrow's. That persistence would dominate any analysis. The change strips away background and isolates the response. So the question becomes, when returns are negative, does volatility tend to increase the next day? If yes, the relationship is asymmetric. If not, volatility moves independent of direction. Here's what we would hope to find. For equity indices, the correlation is clearly negative. Negative returns push volatility up. Positive returns leave it unchanged or push it slightly down. And that effect should be structurally different in metals. Gold and silver respond to different fundamentals: supply constraints, inflation expectation, and current dynamics. If equities show a strong asymmetric pattern and metals show a weaker one, then our EWMA model faces a specific structural problem. It treats all assets identically. That is the hypothesis we want to test. We apply the same EWMA model to our four assets: SPY, the S&P 500 ETF, the Dow Jones, the oldest major US equity index, and gold and silver via an ETF. No parameter tuning, no adjustment for asset classes. Lambda equals 0.94 throughout. For each asset, we first compute the mentioned correlation, and second, the average returns in high volatility versus low volatility regimes, where high means the top 20% of observed EWMA volatility and low means the bottom 20%. Third, we calculate rolling correlations over 1-year windows to see whether the relationship is stable or concentrated in certain periods. And lastly, the tail test. We isolate the bottom 5% of daily returns and measure how volatility responds the next day. The EWMA variance recursion is the following formula. With lambda equals 0.94, this means roughly the last 17 trading days carry more than half the total weight. The regime thresholds are computed from a rolling quantile window of 252 trading days. The regime labels are then as follows. The volatility change we measure is simply the difference between tomorrow's volatility and today's volatility. And the core statistic is the correlation between today's return and the mentioned delta of today's and tomorrow's volatility. Here's what we find. The equity indices show a correlation roughly 4 to 5 times stronger than the metals. The sign is consistently negative across all four assets, but the magnitude differs substantially. With thousands of observations, even small correlations can be statistically distinguishable from zero. The equity values at around minus 0.11 are particularly robust given the sample size. The meta values are smaller and would require separate significance testing to interpret precisely. We also compare average daily returns inside high volatility and low volatility regimes. For SPY and the Dow Jones, the results are now on the screen. Take a moment and pause and ponder what those results could mean. The pattern is persistent. High volatility periods show lower average returns, but both values are positive. High volatility does not mean the market is falling on average. It means the drift is compressed. In gold, high volatility is associated with slightly negative average returns. In silver, both regimes show near zero or slightly negative drift. These are raw daily mean returns. The differences are small in absolute terms and should not be interpreted as tradable signals without further analysis. Now the tail test. We isolate the worst 5% of daily returns for each asset. Then we measure the average volatility change the following day. Again, I will show the results on screen and you can think about it for a moment. The asymmetry is clear. Tail events in equities are followed by a systematic increase in volatility. Normal days are followed by a near zero or slightly negative change. Gold shows essentially no systematic volatility response to its worst daily returns. Silver shows a response comparable in magnitude to equities, but this result sits alongside very weak full sample correlations. It is possible this is driven by a small number of extreme events rather than a stable pattern. Without further decomposition, we cannot confidently claim the same structural mechanism. The eroding correlation analysis adds context. The range includes positive values. That means the relationship reverses in some periods. It is not a structural constant. It is state dependent. All four assets show periods where the correlation signs flip. The equity effect is stronger on average, but it is not always present. Now we can read these results back into the model structure. The EWMA model updates volatility using squared returns. Squaring removes sign information. A return of plus 2% and minus 2% enter the update identically. But our results show that negative shocks in equity markets produce systematically larger volatility responses than positive shocks of the same size. These are not tuning problems, they are structural. A standard approach to the first weakness is the GAR-Garsh or E-Garsh model, which introduces an asymmetric response term that weighs negative shocks differently from positive ones. The second weakness suggests that model parameters should be estimated separately per asset, or that asset classes conditioning should be built into the regime definition. The third suggests regime switching frameworks, where model parameters are themselves allowed to vary across states. Each of these improvements targets a specific structural gap, not a calibration gap. If you're interested, we will look at what an asymmetric extension of this model looks like and how far it can go in addressing what we found here.